Are you looking to grow your wealth through real estate? Tired of the same old advice that doesn't seem to work? You're not alone. You're watching Prosperity Pulse Point, and we're uncovering some real estate strategies that can supercharge your portfolio. Whether you're a seasoned investor or just starting, this video is packed with actionable insights. And like always, I'm not just going to give you information. I'll share a secret formula that can significantly boost your returns. But you'll have to stick around to the end to discover it. Chapter 1. Safe and Risk-Tolerant Investments. Let's talk about risk. It's a word that often sends shivers down investors' spines, but that's a reality we can't ignore in real estate. However, fear not. We're not here to scare you off. Instead, let's approach risk with understanding and balance. Imagine risk as a spectrum. On one end, we have safe investments, the steady, reliable pillars of your portfolio. These are properties that offer consistent rental income with minimal risk of loss. Think of single-family homes in established neighborhoods with a history of stable rental markets. They might not promise sky-high returns, but they provide a predictable cash flow and long-term appreciation. They're like that dependable friend you can always count on. On the other end of the spectrum, we have risk-tolerant investments. This is where the excitement and potential for higher rewards lie. We're talking about flipping houses, commercial real estate, and development projects. These ventures can offer substantial returns, but they also come with greater uncertainties. It's like investing in a startup. There's potential for massive growth, but there's also a risk of failure. The key to success lies in finding the right balance between these two extremes. A well-diversified portfolio should be like a sturdy house with a strong foundation of safe investments and exciting additions that can add value and potential for growth. Remember, everyone's comfort level with risk is different. What might feel risky to one person could be a calculated gamble for another. The most important thing is to understand your own financial situation, goals, and risk tolerance before making any investment decisions. Chapter 2. Ready-to-go properties. Imagine finding a property that's already move-in ready, with tenants lined up and rent checks rolling in. Sounds like a dream, right? Well, that dream can become a reality with ready-to-go properties. These are properties that are already renovated, occupied, and generating income. They're essentially turnkey investments. The obvious advantage is time saving. You skip the hassle of renovations, tenant search, and property management setup. It's like buying a business that's already up and running. Plus, you get to enjoy immediate cash flow from day one. However, there's a catch. Ready-to-go properties often come with a higher price tag. Because of the convenience factor, sellers usually price them to reflect the minimal effort required from buyers. As a result, your potential return on investment might be lower compared to fixer-uppers. So, when should you consider ready-to-go properties? If you're a beginner investor looking for quick returns and passive income, these properties can be a great starting point. They're also ideal for those who prefer a hands-off approach to real estate investing. But if you're aiming for maximum returns and don't mind rolling up your sleeves, you might want to explore other options. Chapter 3. Land Contract or LC Notes. Now, let's talk about a less conventional investment, land contract notes. This is where things get a bit more interesting. Essentially, a land contract note is a seller financing agreement. Instead of getting a traditional mortgage, the buyer makes payments directly to the seller over a predetermined period. As an investor, you can become the seller in this equation. You own the property and the buyer makes payments to you. This can lead to higher returns compared to traditional rental properties. Plus, you have the potential for property appreciation. However, land contract notes aren't without risks. There's always the possibility of default, and the legal complexities can be overwhelming. It's essential to have a solid understanding of real estate law or work closely with legal professionals. Land contract notes are ideal for investors with legal expertise or those willing to partner with knowledgeable professionals. If you're comfortable with the risks and can navigate the legal landscape, this strategy could be a lucrative addition to your portfolio. Chapter 4: Diversification. Diversification is a golden rule in investing, and real estate is no exception. Spreading your investments across different property types and locations can significantly reduce risk. Imagine putting all your eggs in one basket. If that basket drops, you lose everything. But if you have your eggs in multiple baskets, the impact of one basket falling is minimized. Let's talk about the different types of real estate investments. You have residential properties, single-family homes and apartments, commercial properties such as offices and retail spaces, and industrial properties, warehouses, and factories. Each type has its own market dynamics and risk profile. Geographic diversification is equally important. Investing in properties in different cities or even states can help you weather local economic storms. For example, if the economy in one city is struggling, the performance of your properties in other locations can offset the losses. But diversification alone isn't enough. You need to actively manage your portfolio. This means regularly monitoring your investments, analyzing market trends, and making adjustments as needed. It's like tending to a garden. You need to prune, fertilize, and remove weeds to ensure healthy growth. Active management allows you to seize opportunities and mitigate risks. For instance, if you see a promising up-and-coming neighborhood, you can allocate more funds to that area. Or if a particular property is underperforming, you can consider selling it to reinvest in a better opportunity. Chapter 5: Flip and Hold. The flip and hold strategy is a popular choice among real estate investors. It's a two-step process. You buy a property, renovate it, and then sell it for a profit, the flip. Once you've built up your investment portfolio, you can hold on to some properties for long-term rental income. The potential for high returns is the biggest draw of flipping. By identifying undervalued properties and transforming them into desirable homes, you can make significant profits. And when you decide to hold on to some properties, you create a steady stream of rental income. However, flipping and holding requires a substantial upfront investment. You need funds for purchasing the property, renovations, and holding costs. Moreover, the real estate market is dynamic. If you can't sell your flip property quickly, you might end up holding it longer than planned, which can impact your overall return. The flip and hold strategy is ideal for investors with access to capital and a deep understanding of the local real estate market. If you have a knack for identifying undervalued properties and have the financial resources to execute your plans, this strategy could be a profitable venture. Chapter 6: Indirect Investment. Alright, let's get to the secret formula I promised. It's not a magical potion, but a strategic combination of approaches that can supercharge your real estate investments. First, consider indirect real estate investment strategies. These offer a way to participate in real estate without the heavy lifting of property ownership. One popular option is investing in real estate crowdfunding platforms. These platforms pool funds from multiple investors to purchase properties. Another avenue is investing in real estate-focused mutual funds or exchange-traded funds or ETFs. These funds offer diversification across various property types and locations. Indirect investment benefits include accessibility, lower investment thresholds compared to direct property ownership. Diversification, spread your risk across multiple properties or markets. Professional management, experienced professionals handle property management and investment decisions. Liquidity, easier to buy and sell compared to physical real estate. Second, direct investment. This is for those who prefer a more hands-on approach. You can invest directly in real estate companies. However, due diligence is essential. Understand the company's business model, financial health, and management team before committing your money. Third, leverage real estate agents. These professionals have in-depth market knowledge. Building relationships with multiple agents can provide you with a pipeline of investment opportunities. Clearly communicate your investment goals, budget, and preferred involvement level. Finally, consider partnering with property management companies. Outsourcing property management can save you time and effort. These companies handle tenant screening, rent collection, maintenance, and even property sales. By combining these strategies, you can create a diversified real estate portfolio that aligns with your risk tolerance and investment goals. And that's it for this video. Thanks for watching. If you found these tips helpful, please give it a thumbs up and subscribe for more real estate investment tips. And don't forget to share it with your friends who are interested in growing their wealth.